There comes a moment in almost every person's financial journey when something shifts. At first, it doesn't look dramatic. There are no fireworks, no lottery tickets, no surprise inheritance showing up in your bank account. In fact, most people miss the moment entirely. One day you're checking your investment account and thinking, is this really worth it? Am I making any progress at all? And then, seemingly out of nowhere, your money starts working harder than you are. The numbers begin to move differently. The growth becomes noticeable. The account balance starts increasing even during months when you didn't contribute much. And suddenly you realize something powerful. You are no longer building wealth alone. Your money has joined the team. That moment changes everything. Now here's the truth most people never hear. Building wealth isn't a straight line. It isn't about making six figures overnight. It isn't about finding the perfect stock. And it certainly isn't about getting lucky. Real wealth tends to grow in stages. There are specific milestones that act like financial tipping points. Before you reach them, progress feels painfully slow. After you reach them, momentum starts doing a lot of the heavy lifting. Understanding these milestones completely changed the way I think about money, investing, and long-term financial freedom. Because when you know what's happening behind the scenes, you're much less likely to quit during the hardest part of the journey. And unfortunately, that's exactly when most people give up. Before we talk about those 3 life-changing milestones, we need to address something that frustrates almost every new investor. Why does investing feel so slow in the beginning? Why can you spend years saving diligently and still feel like you're barely moving forward? The answer is simple. During the early years, your contributions matter far more than your investment returns. Think about it. Imagine someone decides to invest $50 every month. They're consistent. They're disciplined. They don't miss contributions. They stay committed even when friends are spending money on things they can't afford. After 3 years, they've invested $1,800 of their own money. That alone deserves recognition because saving money consistently is not easy. Anyone can say they want financial freedom. Anyone can watch videos about investing. Anyone can dream about retirement, but actually setting money aside month after month, that's where most people struggle. So if you've managed to build that habit, you're already ahead of the majority of people. But here's where disappointment often creeps in. When you look at your account after those first few years, you'll notice something. Most of the money sitting there came from you. Not from investment gains, not from market growth, not from some magical compounding effect everyone talks about. You put the money there. The returns are still relatively small, and that can feel discouraging. You start wondering if investing is overrated. You question whether all the sacrifice is worth it. You look at your balance and think, I've been doing this for years, and it still feels like I'm carrying the entire load. The reality is that you are carrying the entire load, at least for now. And that's exactly why so many people quit right before things get interesting. They mistake the beginning of the journey for the entire journey. They assume tomorrow will look exactly like today, but investing doesn't work that way. Wealth creation follows a curve. The early stages feel slow, painfully slow, then momentum arrives, then growth accelerates, then compounding begins showing off. To understand why, let's talk about one of the most powerful forces in personal finance, compounding. People throw this word around all the time. It's become one of those financial buzzwords everyone has heard, but few people truly appreciate. Compounding simply means your money starts earning returns on previous returns. In other words, your growth begins creating more growth. Let's keep it simple. Suppose you invest $100 and earn a 10% return. At the end of the year, you have $110. The next year, you're no longer earning returns on $100. You're earning returns on $110. Another 10% return brings you to $121. Notice what happened. You didn't invest more money. You didn't work extra hours. You didn't take additional risk, yet your gain increased. The first year you earned $10. The second year you earned $11. That extra dollar may not sound exciting, but it's evidence that compounding has begun. Now imagine that process repeating year after year. Then imagine adding new contributions every month. Then imagine doing it for decades. That's when the math becomes extraordinary. Most people dramatically underestimate what consistency can accomplish over 20, 30, or 40 years, not because they're bad at math, but because our brains are wired to think linearly. We expect results to grow in straight lines. Compounding grows in curves, and curves don't look impressive at first. They look boring, then suddenly they don't. This brings us to the first major wealth milestone, the first number that changes how you view yourself as an investor. The first point where you realize, I can actually do this. That number is $10,000. Now, I know what some people are thinking. $10,000 isn't enough to retire. It isn't enough to become financially independent. It isn't enough to quit your job. That's true, but you're missing what makes this milestone so important. The value isn't just financial, it's psychological. Reaching $10,000 proves something incredibly important. It proves you can build wealth. That might sound obvious, but it's not. Most people spend their entire lives believing wealth is something other people have. They think rich people are different, smarter, luckier, more connected, better educated, born into better circumstances. But when you see $10,000 sitting in your own investment account, something changes inside you. Suddenly, wealth is no longer theoretical. It's tangible. It's real. It's yours. You begin seeing yourself differently. You stop thinking like someone trying to get ahead and start thinking like an investor. And that shift matters more than most people realize, because wealth isn't built by one great decision. It's built through thousands of small decisions repeated over many years. When you hit $10,000, you've demonstrated discipline, you've demonstrated patience, you've demonstrated consistency, you've resisted temptations, you've delayed gratification, you've built a habit that can serve you for the rest of your life. And here's another reason this milestone matters. Even if you stopped contributing entirely, that money would continue growing. Imagine reaching approximately $10,000 and deciding never to add another dollar. Assuming an average long-term return, that money could still grow several times over during the next couple of decades. Would it make you financially independent? No. But it would prove something powerful. Money can grow without your direct labor. For most people, that's a revolutionary realization, because most of us are taught to exchange time for money, work more, earn more, work less, earn less. Investing introduces a different concept, money earning money, and once you understand that principle, you never look at finances the same way again. Now let's take this one step further. One of the fastest ways many people can accelerate toward this first milestone is by taking full advantage of retirement accounts and employer-sponsored plans. Far too many workers leave free money on the table every single year. They contribute less than their employer match. They ignore retirement benefits. They delay enrollment because retirement feels far away. And in doing so, they unintentionally slow down their wealth building journey. Think about it. If someone offered to instantly increase part of your investment contribution, would you turn them down? Of course not. Yet that's exactly what many employees do when they fail to take advantage of available matching programs. Those contributions don't just add money, they add momentum. And momentum is everything in the early stages, because the hardest part of building wealth isn't mathematics. It's motivation. It's staying committed long enough to see results. It's believing in the process before the process gives you proof. That's why the $10,000 milestone is so important. It's your first major piece of proof. Proof that the system works. Proof that your sacrifices matter. Proof that you're capable of creating a different financial future. And once you've reached that point, you're ready for the second milestone. The milestone where your money begins doing serious work on your behalf. the milestone that transforms investing from a habit into a wealth building machine, the first $100,000. If you've spent any time around successful investors, you've probably heard this number mentioned before, and there's a reason for that. Many experienced investors will tell you that earning the first $100,000 is harder than earning the second. The second is harder than earning the third. And every milestone after that tends to arrive faster than the one before it. At first glance, that doesn't make much sense. How could earning $100,000 be just as difficult as earning the next $100,000? After all, the numbers are identical, but the math behind investing tells a very different story. The first $100,000 requires you to do most of the heavy lifting. You're making contributions. You're staying disciplined. You're fighting the temptation to spend. You're ignoring market noise. You're sticking to the plan during good years and bad years. You are the engine. But once you reach $100,000, something remarkable begins happening. Your investments start generating meaningful amounts of growth. Growth you didn't directly work for. Growth that arrives whether you're sleeping, working, traveling, or spending time with your family. This is where investing becomes exciting, not because you're suddenly rich, but because the relationship between effort and results starts changing. Let's imagine two people. The first person has no investments at all. The second person has a $100,000 portfolio earning an average long-term return. Who has the easier path toward the next $100,000? Obviously, the second person, because they already have an asset generating growth. Their money has become productive. It's gone from being something they own to something that works. And that distinction is incredibly important. For years, many people focus exclusively on income. How can I earn more? How can I get promoted? How can I negotiate a higher salary? Those questions matter. But eventually there comes a point where your investments begin contributing just as much to your financial progress as your paycheck. That's when wealth creation starts feeling different. That's when you stop relying entirely on your own effort. Imagine reaching age 35 with $100,000 invested. Let's say you never contribute another dollar. No monthly deposits, no annual contributions, nothing, just time and growth. Over the next few decades, that money could potentially grow into a seven-figure portfolio. Think about that for a moment. The money you invested years ago could continue working for you long after you've stopped actively contributing. This concept has become known as Coast FIRE. FIRE stands for Financial Independence, Retire Early. But Coast FIRE takes a slightly different approach. Instead of trying to save aggressively forever, you build a large enough investment base early on that future growth does most of the work. Once you reach that point, you can ease off the accelerator. Maybe you switch careers, maybe you work fewer hours, maybe you start a business, maybe you prioritize experiences and family over maximizing income. The beauty isn't necessarily retiring early. The beauty is having options, and financial freedom is really about options. It's about choice, the ability to decide how you want to spend your time, the ability to walk away from situations that no longer serve you, the ability to design your life instead of simply reacting to it. Now, let's be realistic. Most people won't reach $100,000 by age 35 and then completely stop investing. Life rarely follows perfect financial plans. There are mortgages, children, unexpected expenses, career changes, economic downturns, and dozens of other factors. But that's okay. The lesson isn't that everyone should stop investing after reaching $100,000. The lesson is understanding how powerful that milestone really is. Because when you see what $100,000 can potentially become, you begin appreciating the value of consistency. You stop focusing on short-term market movements. You stop worrying about daily headlines. You stop obsessing over whether the market went up or down this week. Instead, you focus on ownership. You focus on time. You focus on staying invested. And those habits tend to create better results than constant activity. One of the biggest mistakes investors make is believing they need to do something all the time: buy, sell, trade, react, adjust, change strategies, chase trends. But wealth often rewards patience more than action. The investors who build significant wealth are usually not the ones making the most moves. They're the ones staying committed for the longest periods, because time is the secret ingredient. And unfortunately, it's the one thing nobody can buy. You can earn more money, you can build more skills, you can find better investments, but you cannot create more time. That's why starting early matters so much. Not because you're trying to become wealthy tomorrow, but because you're giving compounding decades to work its magic. Let's imagine someone invests $500 every month. Will they become wealthy overnight? Of course not. There will still be years where progress feels slow, years where markets struggle, years where motivation disappears, years where it feels easier to quit than continue. But every contribution strengthens the foundation. Every month adds another brick. Every year increases momentum. Eventually, those small actions create something extraordinary. The challenge is that most people want extraordinary results before they've put in ordinary consistency. They want year 20 results during year 2. And when those results don't appear, they become discouraged. But investing isn't about speed, it's about endurance. The people who win financially are often the people who simply refuse to quit. They keep showing up, they keep contributing, they keep believing, even when the evidence isn't immediately visible. That's why the journey from $10,000 to $100,000 is so valuable. It teaches patience, it teaches discipline, it teaches resilience. Most importantly, it teaches trust. Trust in the process. Trust in the math. Trust that today's sacrifices are creating tomorrow's opportunities. And once you've reached that six-figure milestone, something fascinating happens. You begin noticing that each new milestone arrives faster. Not because you're working harder, but because compounding is now helping carry the load. The snowball is rolling downhill, and every rotation makes it larger. Every year increases its momentum. Every gain creates the potential for bigger gains in the future. This is why successful investors become so passionate about staying invested. They understand something many people don't. The biggest rewards often arrive near the end of the journey, not the beginning. Most of the growth happens after years of patience. Most of the wealth appears after decades of consistency. Most of the magic happens after people would have already quit. And that's exactly why reaching $100,000 matters. It's proof that you've stayed in the game long enough to experience the power of momentum. But as impressive as $100,000 is, it still isn't complete financial freedom. It creates options. It creates flexibility. It creates confidence. But there is another milestone, a milestone so significant that it fundamentally changes the relationship between work and money. A milestone where your investments begin generating income at a level that rivals or even exceeds many full-time salaries, and that milestone is $1 million. Now, before you stop reading and think, "That's impossible," let me say something important. Most people don't become millionaires through extraordinary income. Most don't win the lottery. Most don't invent the next billion-dollar company. Most simply invest consistently for a very long time. That's the part social media rarely talks about. Millionaire status often looks surprisingly boring. It's built through repetition, patience, consistency, and time, not excitement, not shortcuts, not financial miracles, just steady progress repeated over decades. And when you finally understand what $1 million portfolio can do, you'll see why so many investors stay committed through the difficult years. Because at that point, your money is no longer assisting you. It's carrying a significant portion of the load. And that's where the journey becomes truly life-changing, the $1 million mark. For many people, just hearing that number feels overwhelming. $1 million sounds like something reserved for celebrities, business owners, professional athletes, or people who were born into wealth. But here's what I've learned after years of studying personal finance. The biggest obstacle standing between most people and financial freedom isn't math, it's belief. Most people never get close to $1 million because they never truly believe it's possible for them. They assume wealth belongs to someone else, someone smarter, someone luckier, someone with advantages they don't have. But when you look closely at the stories of ordinary millionaires, a different picture emerges. Many of them weren't extraordinary earners. Many didn't have perfect timing. Many made mistakes. Many experienced setbacks. Many lived through recessions, job losses, market crashes, and periods of uncertainty. What separated them wasn't perfection, it was persistence. They stayed invested, they stayed focused, they stayed patient, and eventually time rewarded them. Now let's look at what happens when a portfolio reaches $1 million. Assuming a long-term average return of around 8%, a $1 million portfolio could potentially generate approximately $80,000 in growth in a single year. Read that again. Not through working overtime, not through taking a second job, not through sacrificing weekends, simply through ownership. The following year, assuming growth continues, the gains become even larger. And over time, those returns begin stacking on top of previous returns. The compounding effect that felt invisible at $10,000 suddenly becomes impossible to ignore. This is where many investors experience a mindset shift. For years, they viewed investing as something they were funding. Now they begin viewing investing as something that is funding them. That's a completely different relationship. Instead of asking, how much can I contribute? They start asking, how much income can my investments generate? Instead of focusing entirely on their paycheck, they begin paying attention to the income-producing power of their assets. And that is one of the biggest transformations that can happen in personal finance, because true wealth isn't about how much money passes through your hands. It's about how much money continues flowing to you without requiring your constant effort. Think about the average person's working life. Most people spend decades trading hours for income. They wake up early, commute, work hard, solve problems, meet deadlines, handle responsibilities, and in return, they receive a paycheck. There's nothing wrong with that. Work can be meaningful. Work can provide purpose. Work can create opportunities. But relying entirely on earned income creates vulnerability. If you stop working, the income often stops too. Investments create another stream, one that doesn't depend entirely on your time, one that continues operating even when you're not. And that's why reaching 7 figures is such an important milestone. It's not about bragging rights. It's not about impressing other people. It's not about posting screenshots online. It's about freedom, freedom to choose, freedom to pivot, freedom to walk away, freedom to spend your time according to your values rather than your financial obligations. Now let's talk about something that's often misunderstood. When people hear about $1 million portfolio, they immediately assume that means someone can spend $1 million. That's not how financial independence works. A portfolio isn't meant to be drained, it's meant to support you. This is where the famous 4% rule enters the conversation. The idea is relatively straightforward. Historically, retirees who withdrew approximately 4% of their portfolio annually had a strong probability of making their money last for decades. Using a simple example, a $1 million portfolio could potentially support annual withdrawals of around $40,000. The remaining money stays invested and continues growing. Of course, real life is more complicated. Markets fluctuate. Inflation changes purchasing power. Individual circumstances vary, but the principle remains important. Financial independence isn't necessarily about spending all your money. It's about creating a system where your assets support your lifestyle. And here's something that often surprises people. Many individuals who reach financial independence don't actually stop working. Instead, they start working differently. They pursue passion projects. They start businesses. They volunteer. They mentor others, they create, they teach, they contribute. The difference is that they're working because they want to, not because they have to. That distinction changes everything because when financial pressure disappears, your decisions become clearer. You can say yes to opportunities that excite you. You can say no to opportunities that don't align with your values. You can prioritize health, relationships, experiences, purpose, the things that ultimately matter most. And that's an important reminder. Money is powerful, but money is not the goal. Money is a tool, a very important tool, but still just a tool. Too many people accidentally spend their entire lives chasing financial success while forgetting why they wanted it in the first place. They postpone happiness, delay experiences, ignore relationships, neglect their health, convince themselves they'll enjoy life someday, after the promotion, after the raise, after the next milestone, after retirement. But life doesn't work that way. The future isn't guaranteed. And while building wealth matters, so does living. That's why balance is essential. You don't need to choose between enjoying life and preparing for the future. You can do both. You can save responsibly while still creating memories. You can invest consistently while still taking vacations. You can build wealth while still enjoying dinner with people you love. In fact, that's exactly what wealth should support. A meaningful life, not just a larger account balance. Some of the happiest people I've met aren't necessarily the richest, and some of the wealthiest people I've met aren't necessarily the happiest. The difference often comes down to purpose. Money amplifies who you already are. It creates opportunities, it provides security, it offers choices, but it doesn't automatically create fulfillment. That's why your financial journey should be about more than numbers. The numbers matter. The milestones matter, the strategy matters, but they matter because of what they make possible. A parent spending more time with their children, a couple retiring without financial stress, someone leaving a toxic workplace, someone supporting causes they care about, someone helping family members, someone finally sleeping peacefully at night. That's what wealth is really about. Peace, security, choice, freedom. And if you're sitting here today feeling behind, let me leave you with this. You do not need to have everything figured out. You don't need the perfect investment strategy. You don't need a six-figure salary. You don't need to know every detail about the stock market. You simply need to start. Start where you are, with what you have, and with whatever amount you can consistently invest, because the hardest step is not reaching $10,000. It's not reaching $100,000. It's not reaching $1 million. The hardest step is taking the first one. The first contribution, the first investment, the first decision to prioritize your future self. Everything else grows from there. Remember the 3 milestones. The first $10,000 proves you can build wealth. The first $100,000 proves wealth can begin building itself. And the first $1 million proves that your money can create freedom. But none of those milestones happen without the small decisions made today. So start, stay consistent, trust the process, ignore the noise, and most importantly, give yourself enough time for the magic of compounding to work. Because one day, sooner than you think, you'll open your investment account and realize something remarkable. Your money is no longer waiting for you to build your future. It's helping build it alongside you. And that's the moment everything changes. The moment you stop working only for money and your money finally starts working for you. Thank you so much for watching. Take care of yourself. Take care of the people you love. And remember, financial freedom isn't about becoming rich. It's about creating a life where your choices are guided by your values, not by financial fear. I'll see you in the next one.